cap table red flags for you?
Well, so I like to look at the history of the cap table a lot of times to see who's come in and out. You might find that there was a founder that left that they didn't tell you about. So that's always a red flag. For startups giving up a lot of equity to advisors that really didn't do much for them. Biggest one to look out for, though, in my mind is...
My guest today is Jeff Crusey, who is a partner at 7% Ventures, and he's taking care of their space tech investments. In this particular episode, he talked about venture studios, accelerators, and advisors, and how they take out so much equity from founders early on. We also talked about deep tech companies and how they're different from our traditional SaaS.
SaaS companies typically aren't facing a lot of engineering risk. It's more execution and market risk, finding product market fit. And I would say differently for a lot of deep tech companies, there's still oftentimes engineering risk that needs to be retired. And it's not really worth advertising until, whatever widget it is they're building really can perform the way they need it to raise subsequent rounds of funding and scale the business and find product market fit and all that. So I think that's a lot of times why you'll see a lot of these companies remain stealth early on.
Do you think being a first money in is kind of a moat?
I do, actually. And that's a good question because I always worry about selection bias or groupthink in VC and being swayed by others' opinions. We don't want to get caught up in any hype or hysteria in any way, honestly. We want to be able to make good investments independent of what the rest of the market's doing or thinking. And so that's why we like to actually be first or second check-in, because you have to build conviction of your own to do something like that.
Hey Jeff, welcome to the show, sir. How are you doing today?
I'm doing great. Thank you for having me.
Every single time, and we've been doing this for quite some time, every single time we host anybody on the podcast, I start us off with one particular question. And the question that I want to ask you today is exactly the same question. What's the earliest context you have of your life, and how did you end up becoming a VC of all things? So let's start there.
So, what's funny is I went to Wharton undergrad, and when I was at Wharton, I think a lot of people were really interested in consulting or banking or trading. Those are sort of the three paths a lot of students took at that time. And I thought that was going to be my path too. I thought it was going to be some highfalutin Wall Street trader or something. I don't really remember. And I had this project my senior year, and it was one of these classes that was an elective that I left to the last minute. I shouldn't have. It was not smart. But it was called Venture Initiation, where we had to make up a company, write a business plan, put together a pitch deck, and then the final project was to present that in front of the class and a panel of actual VCs, and that was going to be our grade. And so I got put onto a project with a bunch of football players that didn't really want to do the project. And so we didn't do that well, but the professor took pity on me and said, I'll let you redo the project by yourself, but you have to represent it to me in 2 weeks. And this was during the time when everyone's enjoying graduation celebrations and going out and meeting with their families and friends. And I was stuck in the library working on this project, cursing, the high heavens that I'll never have anything to do with writing business plans or early stage companies or technology, none of this. I'm going to go be a trader. And here we are. I fell into it by mistake. I went into banking. I didn't enjoy it. I didn't care about leveraged buyouts. It turns out I was more interested in earlier stage technology and sort of what could be and those exciting founders at that stage. So while I was at this investment bank, I very naturally gravitated towards all the earlier stage work. And then it was after that I decided I was going to go try VC for the first time. And I ended up actually deciding that biomedical investment wasn't really my forte, or wasn't exactly my interest at that point in time. And climate and energy were more interesting to me. And this was in 2008. I went and interviewed at a bunch of Silicon Valley firms. Didn't really think a lot of people had a clue of what they were talking about. Mainly software investors that wanted to go invest in these technologies that were more rooted in chemistry and electrical engineering and other fields. So ended up joining a team that was a corporate venture arm of a utility in Detroit, Michigan, called DTE Energy Ventures, where myself and another guy led that practice. And I thought it was a much more interesting place to do that from, because I was surrounded by the industry in a lot of ways. The parent company, the utility, their three largest customers were the auto manufacturers in Detroit. So I got to work closely with them. They owned a lot of midstream gas assets. So we got a better look at what competition really was for solar and wind and a lot of those technologies back then. There is a lot of political intersection at a utility as well. So we got to understand the direction of policy a bit better, could take advantage of some of those policies in terms of funding our startups and whatnot. So I just thought it was a better seat and place to do that from. And I learned I really, really loved venture capital and I enjoyed it, but I needed to go do a lot more learning before I could come back to it eventually, because I wasn't really technical at that point in my career, and I hadn't really worked at a startup and understood operationally how these things evolve. And so I decided, all right, market just bottomed out. I've got 10 years before it picks up. Let's go spend that time working at startups, getting technical background, and understanding how to build these businesses.
How important is it for a VC operator / GP to come from the same background that he's investing in? So anybody who is investing in, suppose, space tech, how important is it for that fund manager to actually come from that background, to have that operator sort of a badge to him? Is that important? Is that not important? How important is that? So yeah.
I think it's personally, I think it's pretty important. We'll just use space as an example. I think absent any background in all the plethora of different technologies that are involved in space, it's really hard to diligence whether or not a company's strategies or technology development roadmap or anything they're doing makes any sense. And it's really hard to help a company also if you can't think from first principles about what they're building and in terms of both the technology and business. And so, that's when it just looks like dumb money at that point. It's just a check. And I've been a founder. I know how hard it is. And you know what? I would take any good help I could get. And if that meant somebody that's got a network and can challenge my ideas, that's who I'd rather take a check from than just somebody that's got a brand.
I want to start us off with this one particular question, which is around the company that you're running now, which is 7%. So what's the investment thesis that you have? What sort of sector do you invest in? So let's start us there. And then I'm going to ask you a lot of the questions when it comes to the technicalities of all these startups, because these are definitely not even close to traditional SaaS. So yeah, let's start with what is 7%, what you guys are working on, sort of the company you invest in. What's the investment thesis that you guys have there?
Absolutely. So the way we like to talk about 7% is in sort of two tracks. We have Frontier, which is traditional deep tech, space, defense, semiconductors, photonics, advanced computing, human tech, climate tech, a lot of different areas that I think notionally we all kind of have an idea for what they are. And then the other one we call transformational, and that is laggard markets where we can deploy a known solution that scales and disrupts quickly. And a good example of that would be like our investment in Flexport and modernizing the freight forwarding. So those are sort of the two tracks. And then what are we excited about right now? There's a few big themes that we're excited about right now. One of them is how answering this question about the AI compute demand that everyone's projecting in the future. A lot of people like Sam Altman are talking about raising $7 trillion because we need to develop all this compute for AI that we'll need in the future. I don't know. I don't know if we should give him $7 trillion, but I agree notionally that yes, we need to make more efficient our computing because I think there is going to be a lot more demand in the future. And so 7%, we made an early investment in a company called Vera Computing that just recently on stealth that's doing reversible computing, just to try and answer that question. And what that means is just ultra low power compute by virtue of the new architecture.
Okay, so so the SAM news is pretty interesting to see. Like $7 trillion, that's a lot of money. Like that's a lot of money. I don't know, 99% of the company, or at least 95% of the countries in the world does not have bigger economy than what he's asking for this thing. But worth it, not worth it, I don't know. And I'll come back to the AI related question later on. But two things that you mentioned, which is a stealth startup, and all these are the different different sort of a tech. I would call them traditional deep tech / non-SaaS tech. Let's put it that way. So let's just start with that. In SaaS, and then the reason why I'm going to ask you a lot of the questions from SaaS and CPG world is just because most of the time the VCs that I happen to invite on the podcast, they come from that traditional background. Like, they're investing in traditional SaaS, in food and beverage, in CPG or something. So the question that I want to ask you is, when it comes to building any of these platforms, personal branding is like very, very important. Like these startups are kind of built in public. Like everybody's just, going on Twitter, ranting about that, and then on LinkedIn talking about that and stuff or whatnot. But usually what I've seen that is all deep tech companies stay in the stealth mode for quite some time before they come out of that, and then makes a huge media announcement, which is totally fine. Why these startups need to stay in the stealth mode and not be built in public? So that is the first question. Yeah, and the second one I'm going to ask you is in terms of SaaS and in terms of all these things. So the comparison that I want to draw is how these deep tech companies, deep tech ideas. How do you guys evaluate those ideas? Because SaaS looks pretty important, pretty simple. You look at the TAM, you look at the market share, you look at this, and you look at that, and you look at the traction. So yeah, how do you differentiate like which idea is a good one, which idea is not a good one in deep tech? So yeah, two-part question because I want you to go in depth. Yeah, go ahead.
Yeah, absolutely. To answer your first question about why do a lot of deep tech companies remain in stealth earlier on, I would say SaaS companies typically aren't facing a lot of engineering risk. It's more execution and market risk, finding product market fit. And I would say differently for a lot of deep tech companies, there's still oftentimes engineering risk that needs to be retired. And it's not really worth advertising until, whatever widget it is they're building really can perform the way they need it to raise subsequent rounds of funding and scale the business and find product market fit and all that. So I think that's a lot of times why you'll see a lot of these companies remain stealth early on. And there's just no point in spending a lot of time on marketing themselves because they're just not at that stage yet. And then to answer your question about how do we diligence these deep tech companies, that is a big question because there is no one size fits all approach to evaluating deep tech companies because it's oftentimes very different categories of technology we're looking at and different strategies that need to be employed, different business models and whatnot. So I think the way we like to diligence it, first, like we know that we don't have all the answers. Like Jeff does not have a monopoly on good ideas, right? That's just never going to happen. I know that already. So we always want to make sure that we are supplementing our understanding with that of a deep domain expert. And so what we've done is developed a very large network of advisors and venture partners that can drop in and help us with that to give us, if we aren't up to speed in an area of technology, they can hopefully get us up to speed, can give us sort of a landscape view of competition, understand what those pathways look like, potential customers and whatnot. So I would say we look at a lot of the same kind of categories of information we would need to understand how a company could be successful. As you would in a lot of other areas of VC, it's just having sort of that domain expertise in those different areas and understanding from first principles how those companies could be successful is where sort of we like to specialize in.
Okay, awesome. So usually, and I think maybe it's because of the AI, maybe it's because I don't know if it's not because of the AI, but the barrier to entry when it comes to build any SaaS business is pretty low. Like all you need to do is like there's a few steps, pretty well described. A lot of people have done that successfully, repaired that. So when it comes to SaaS companies, and I was just happen to host a lot of VCs on the podcast, and they get like thousands and thousands of pitch decks every year. So very funny question, like how many applications do you guys actually get in terms of pitch decks and investments and stuff like that? Like is it like, oh, we get like 10,000, which is amazing because 10,000 people are thinking about innovating the future, or is it like, oh, maybe only 10 or 20 or something like that? So what's the right number here?
Yeah. So, I mean, we try to do our best to track it all, and be diligent about that because we want to make sure we're giving everything a fair look and response to founders of the inbound from whatever source it comes from. I mean, we're seeing well over 2,000 companies a year, and I'm sure the real number is actually higher than that. Because I'm terrible at LinkedIn. It's like hard for me to field all that. But we also have a massive network of folks that can give us sort of a pre-validated look at some startups.
Awesome. All right. So just want to dive deeper into a little bit more of a comparison between the SaaS companies and between all of that. When I think about deep tech, consumer tech, space tech, biotech, like the hard tech, I would call that. When I look at that, one thing that comes to my mind is the capital costs are going to be exceptionally high compared to a SaaS business, right? Because it's like there's a lot of investment in to build the next NVIDIA, whatever graphic card or whatever. And if that fails, NVIDIA is pretty big; they can afford that. But anybody just starting out, so obviously the capital cost is pretty big. So, what exactly is the thought process that you guys have behind any investment decision? So, like you can't be, because I'm not sure if that's the unit economics. I'm not sure like what exactly. How do you look at one particular pitch deck and you're like, so if we were to invest in this thing, these are the risks. This is how we evaluate the idea. So what exactly is the thought process behind investment decision and these potential risks?
Yeah, I would say the starting point's usually the pedigree of the founding team. Do they have the right background for this kind of a business? And so a lot of times we're looking for deep domain expertise, a lot of experience in the industry. Prior to that, maybe having already been a founder before and through that process. We look for not just technical backgrounds, but also a blend of commercial mindedness as well. Because, I mean, after all, they need to make money, right? So, like, if, you can't have a team full of CTOs, it's not going to be a wise decision. Yeah, exactly. So, so we spend a lot of time on, with teams, talking to them, getting to know them as an individual, understand the dynamics between them, whether or not they have the staying power, because very often, and I can't remember if this is still the number one reason, but very often the reason for failure of an early stage startup is founder breakup. And so if we already know that,
in the deep tech world, or in just like all the other startups as well?
Yeah, generally speaking, for startups.
Wow. Okay. I thought it was like lack of capital, or people just ran out of capital or something. I mean, that's what I thought.
And I mean I think that's an easy out.
Okay. Okay.
Because I mean, the lack of capital could be because they don't have the right team.
Interesting. Very interesting on that. Okay. Awesome. So another question, which was probably the last question that I want to ask you on the same comparison thing, which is more like, how do you guys define traction in your industry? And again, going back to what 7% is doing, which is around climate tech, deep tech, hard tech, like all of these things that you guys are investing in. These are all different verticals, albeit overall the same umbrella, but these are all different verticals. So how do you define traction in this industry and that industry and that in this industry? Like, how do you do that?
Yeah, I mean, like you said, it's different depending on the business model. Some startups will have metrics that do look a lot like a typical SaaS companies, where you're looking at different metrics around, the rate of the revenue over different periods of time, and attrition and churn and all that. And then on the other end, there are companies that just there's no such thing as ARR really, and trying to put it in context of ARR is just not really helpful to anyone. And it's funny, I actually see a lot of VCs that when they see like revenue that's not ARR, they freak out. And I'm like, well, I mean, not every company can do that. Like, it's just not possible. Not everything needs to be a subscription. But anyways, it really depends on, the who and what portion of the market or share they've taken. And, depending on that, traction can look wildly different for a lot of different companies. So, let's say, let's talk about a battery company, for example. If they sold a megawatt worth of batteries to a big energy utility conglomerate, that's more interesting than if they sold a megawatt to a small utility in some country far, far away. And so, yeah, both the same amount, but very different profile in terms of what that quality of what that revenue looks like and what it could turn into down the road. So sometimes there's more overhead in that revenue than depending on who's being contracted. So it's different for each industry. It's not a one size fits all approach.
Okay, but and also a question on valuation. Like you guys invest pre-seed and seed. Are the valuation exactly the same or somewhat same as we see in the other side of the world, like in SaaS and CPGs? Like, okay, pre-seed, you're valued at, I don't know, somewhere between 2.5 to 5 million, and then to 10 and something. Or overall, in general, how do you, value these companies? Because what I think is in SaaS or something like that, is just primarily, it's more like you have the MVP and then you can measure the customer ARR and you can just say, okay, 10K a month revenue and then 100K or a million a month revenue or something like that, recurring revenue. But in here, you don't see something like that. It's probably like contracts. Okay, so you're going to secure a contract. There's something in the pipeline. And the things are very much prototype by the time you guys invest in that. So the reason why I want to ask you is that how do you evaluate a prototype in terms of money? That one thing, like the Oculus. I know you guys invested in the Oculus early on. How you guys did that? Like, okay, so it's going to be that much later on.
It's not an exact science.
Okay. There's no formula for that?
No, I wish there was. That would be nice if it would make my life easier. But I would say there kind of is, actually, to some degree. And what I mean by that is in VC, I subscribe to the notion that your fund size is your strategy because, depending on how big your fund is, and what portfolio size you want, it gets determined what size checks you write and what valuations you have to enter in to justify the risk profile of the business. And so to some degree, it is a little bit structural or formulaic because, if somebody raises a $25 million pre-seed fund, it's not as if they're going to go write a $10 million check into a Series A company because that's going to overweight their portfolio and, creates a lot of risk. So to some degree, your strategy is the size of your fund. And so we're kind of bound in terms of valuations by that. And so the way we think about it is we like to be first or second check if we can, like really, really early on, at the point where it's really difficult, honestly, to value a lot of companies. And so that's when you see instruments like convertible notes or SAFEs used. So you can punt on the valuation, till the company's developed a little bit more, and then you can price around. But how do we think about it? Well, we definitely have an upper limit that we want to be disciplined as investors in terms of valuation as well. So the upper limit for us is around $20 million. Much beyond that, then it becomes difficult for us to generate a return, given the risk profile and distribution of successes to failures within early pre-seed and seed stage investing. In what exactly is that figure? It's really depends again on the profile of the company. Some companies have $1 billion of development behind them, in a lab at some university. Some are, just a concept on, some paper somewhere. So, but generally we're sub $20 million, and we're flexible on what that valuation looks like. It depends on the nature of the company.
The reason why I have to ask you is because these ideas are pretty hard to evaluate, because this is a very, very risky business. By the time you guys put any money, it's a very, very risky business. So yeah, that totally makes sense. A follow-up question on that: Do you guys think, because you said like most of the time it's the first money in, you guys are like the first money in, do you think being a first money in is kind of a moat that you guys have, like that is somewhat of a speciality?
I do actually, and that's a good question, because I always worry about selection bias or groupthink in VC and being swayed by others' opinions, which to some degree we should be, right? We should take in information, but we don't want to get caught up in any hype or hysteria in any way. Honestly, we want to be able to make good investments independent of what the rest of the market's doing or thinking. And so that's why we like to actually be first or second check in, because you have to build conviction of your own to do something like that. And we think we're half decent at it. I mean, we've had a lot of top tier funds follow a lot of those checks. And I think that's because they kind of see what we see maybe a little bit later, but that's our edge.
Okay. So tell me a little bit about, and this is something that I want to learn for my personal benefit as well. What advantages do any company, any VC fund has when they lead a round? Like, what exactly do you guys get out of that when you say, I'm just leading a round? So yeah.
Yeah. So what do you get? Well, so a lot of the times, we'll write a first check absent any other investors. We'll write a check to their founder as the first check, and we'll help them develop the business into what would be a subsequent round of funding. And so a lot of times at that pre-seed stage, it's not really leading per se. It's sort of a preemptive check before a priced round. And so, yeah, I wouldn't say those kinds of investments were really leading. But then when a company needs a more substantial amount of capital subsequent to that, we might not be able to fulfill all of that. So we'll need to bring in other investors, and hopefully they've knocked down some milestones by that point. So those other investors see that progress and will come in and co-invest alongside us. In those instances, we might lead because we've been working with the company. We have developed a relationship with the founders. We know what's going on from the inside out, and being able to sort of be the representative for the rest of those investors in that business is kind of what we're doing. We're representing that round of shareholders.
So leading this, so just to circle back on that. So leading around means representing the same thing to other investors, or leading around means putting the most money in for that round, or both?
I mean, it's funny because like the market's been kind of weird. I've seen people lead really big rounds with really tiny checks, which doesn't make a lot of sense to me.
Yeah, exactly.
So typically you're right. It is, you are the largest investor of that round of equity or investment. That's typically the lead. And the responsibility on them is to basically get the round to close. So, they'll write a term sheet, they'll do all their due diligence. If that checks out, they'll draw up the docs, they'll negotiate on the valuation. And then once that's signed, everybody follows in on those terms typically. And so the lead might or might not get a board seat. Sometimes companies don't need a board at that point in time, and it's obstructive and it will slow them down. So they might not need it. Some do though. And so that's usually around the time when you would put together a board seat, or put together a board, and the lead investor would take a board seat. And sometimes some other investors might get an observer seat as well.
Okay. All right. Awesome. Thank you for sharing that. All right. So what I've learned in I don't know, like 5-6 years, because I consider myself a student of venture capital as well. So in the last 6 years or whatever, I've learned this thing that VCs is this power law, the outlier, the home run sort of a business. 1 out of the 100, that kind of a thing. What percent of these companies, especially space tech and deep tech companies, do actually survive the whole thing? And what's the failure rate in this one particular category in this industry?
What's the failure rate? So that there's usually some pretty decent reports that are put out like quarterly that outline that. I don't off the top of my head remember exactly what the distribution looks like, but if we're talking about like percentage of companies that go to zero, I think it's like between 20 and 30%, if I remember correctly. It's last I looked. Yeah, but I mean that distribution looks different for every fund, right? But generally speaking, I think those are like the high headline figures, and it's like only like 5% of your businesses will generate beyond like a 2 or 3x return. But those are the ones you need to make sure occur for the survival of the fund, because like you said, it's a power law distribution.
All right, cool. So how different is it to comparatively, how different is it to launch a humanite robot or a piece of biotech that helps blind people in the vision? Because the margin is like so stupidly low, because when you're dealing with these kind of things, you have to be very, very careful. So how difficult is it to launch a product like this?
Well, I mean, a humanoid robot. I don't know that there's really a market for it today, honestly. I mean, there's like
they're building it. They're building it.
I mean, that's not typically how I like to do things. I like to solve a problem, not just build it and they'll come, which I think is often an error founders make within deep tech. But to sort of answer your question a little bit better, it's hard to describe in any general terms because it's a different pathway for every kind of company. In terms of length of time to exit, for example, BCG actually put out a report, I think it was last year, that tried to investigate this a little bit closer with some data. And I think what they found was that there actually isn't a huge disparity in terms of time to exit between traditional sectors within VC and deep tech sectors. They actually have a very similar profile in terms of time to exit. It's not always been that way. That gap has closed over time. And it's taken a while to do that. But I think that's one of the many reasons why I'm even more excited about all these areas that I've been involved in for so long. It's because now that a lot of these technologies are coming to maturity, now's the time.
Awesome. Great. So Jeff, appreciate it. So what we do is we have a decent big of an audience. So every single time any guest coming out of the podcast, we just send out send out this thing. Hey, Jeff is coming tomorrow. So send us all the questions that you think we should ask him. So we get all kinds of things, like crappiest one and the best one. So I'm not gonna ask you the crappiest one because they're like,
no, go for it. Ask me whatever you want.
So there are a few that we put together. So I'm just gonna ask you something. So yeah, the first one is, how much does the management team and the founders' expertise in aerospace, defense, deep tech, whatever that thing matters, versus bringing an outside industry expert?
I think at initiation, it's really important because
to have an industry expert.
Well, I mean, I think having that domain expertise on the founding team is really important because it's kind of going back to this idea about being able to think from first principles and think strategically, and also attract top talent and do that credibly. And part of the reason you want that deep domain expertise on the team that can do that is because not a lot of times can you just write a paycheck for $1 million to the top expert in the field. You need to get them on board in terms of taking the risk of joining an early stage company where they might not make as much in that they're credible in this potentially being a successful outcome at some point. So I always worry when I see a startup that raises a ton of money that has very little experience and a very young entrepreneur in an area in a lot of the deep tech areas, because it just looks to me like all of a sudden investors are paying somebody a lot of money to learn, which is like, wow, it's already risky. Why would we take on more of that risk? And all they're doing is like basically giving them money to go write some big paychecks to people that are actually going to do the hard work. So I want to get rid of the middleman.
Yeah, sure. Okay. So the second one is your favorite slide on the pitch deck, or maybe there's 2 or 3 of your favorite slides on the pitch deck.
Favorite slide on the pitch deck. So I think with most good pitch decks, there's always a slide on like what the key insight is that nobody else has picked up on that they have. And for me, that's always that's like the secret you get to get in on with the founders. So I mean that's always the fun one that gets me excited. But in terms of like what do I think is important, or what's the most important slide, I mean I if you don't have a slide that talks about why this is the right team at this point in time, none of the rest of the deck matters.
Oh, really? Okay. So is this all about the founding team, all about the people, and it's all about the execution?
I wouldn't say it's the only important thing, but absent, the right founding team, I don't care what the rest of the deck says because it's never going to be executed on properly.
And how do you figure out like this is the right team for this particular problem and this particular solution and this particular time? So how do you do that?
How do I do that? I talk to the founders a lot. I really try and understand what they're seeing, how they arrived there, what mistakes they've made along the way, what their thought process is like, how they interact with others. It probably, I hope people don't feel like I interrogate them, but I mean, there's just a lot of conversation. to really get inside the head of those founders.
Okay. Is there such a thing which is called founder chemistry? Is there such a thing exist?
Oh yeah, definitely is. I mean, I've been through it myself where there was poor chemistry on one of past teams I've been on, and it will inhibit the progress of a company. It'll slow down development, whether it's business or technological, whatever, research. It'll slow everything down, and because if you're distracted with some other issue, your eye is not on the ball. So we definitely look for good founder chemistry, and it's sort of there's not a lot of thing. It's hard to describe. It's sort of something you just kind of know when you see it.
Okay. Yeah. Okay. And if there's not a good chemistry, you can see that pretty quickly as well. Yeah, you can see that.
Yeah, you can definitely pick up on it very quickly. And if the second I do pick up on bad chemistry is, when I'll kind of bring it up and say, hey, you folks might want to take a look at this.
All right. Okay. So the next one is, what are so a lot of companies are raising post-money saves these days. I think that's very familiarized, popularized by YC. In your opinion, as a VC, what do you think are the pros and cons of, like, pros are, I think everybody's aware of that, like, you get some money pretty fast, don't have to do a lot of due diligence, something like that, and then you just spend the time building. So the question that I want to ask you is, I want to take the pros out. So I want to ask you about the cons of saves in terms of like why that's not a good thing for the founders.
The other big mistake with regards to like saves and roll notes I've seen is raising too much on those structures, because it effectively is going to go into the whatever is the next price round at some point, and if that raise is significantly larger than whatever that next round is, I mean, those investors are, everyone's going to be looking at a lot more dilution than they probably expect or want. And then the round dynamics get a little bit warped, and it can actually, I've seen in many cases, it lead to the collapse of a round because there was just too many convertible notes ahead of a price round.
And one thing that I was observed is like people who raise these safe after safe after safe on top of each other, at the end of the day, they feel like, oh, there's like not enough of the company left, without even knowing like how much they've given out. The dilution is like pretty steep in that way. So, okay, cool. All right, so the next one that I want to ask you is your opinion on venture studios and accelerators.
Yeah, I've kind of got mixed emotions because I've worked with a lot of both over the years, and to varying degrees. Some of them are designed just to turn out startups. I've seen some of these, I call them like startup mills, where it's like 10 startups coming out of these accelerators a week, and it's just like you can kind of see how formulaic it becomes, and they're just kind of like throwing crap at a wall, and there's not a lot of high quality startups coming out of them. I tend to avoid those kinds of organizations because they're more concerned with just making sure they get enough companies out the door, that at least a few of them have some outsized return, and they can call themselves geniuses. But like, there's a lot of damage left in the wake, and I don't think that's a great approach. Then there are, and a lot of them don't even write a check, which is like bizarre to me, because they're taking equity, and I'm like, why would you give up equity for a program that's just going to like coach you on your pitch? That's a lot of money to give up for that. And a lot of accelerators are only that. They pretend to be sort of like domain experts, but then you look under the hood and it's really just like they coach you on your pitch and they have a demo day, and that's it. And I'm like, okay, that's not ultimately that helpful. And if I look at like where a lot of like the big impressive companies over the last decade have come out of, it's not a lot of times from accelerators. Some of them have, but not a lot of them. So I also am wary of sort of groupthink within a lot of those organizations as well. I think I see a lot of that happen around YC, where it's just like everyone's trying to invest in these companies before they do demo day, and all of a sudden, some of these startups have raised $20 million before anybody's even really seen them present. Like, it's a little So yeah, it's a bit too much of herd mentality. But there are some accelerators that are great. Like, I love working with the Creative Destructive Lab. They have a great program that I love participating in because they don't take anything. They give a lot of real domain expertise and support to these startups. And it's really organized, and it's just a pleasure to participate in that. And I think that's a great example. And then for like venture studios, I love a lot of these venture studios because as a VC early on in my career, I became very frustrated when I would do my thesis work and I would develop a thesis and then go out to go find a company, and then there's nothing, like those companies don't exist yet or something. And in the past, I would just kind of have to take it on the chin and like move on to another thesis because it's not like I was going to go start those companies. That's changed in my career over that time, where I've started to help incubate early stage companies because I don't really want to wait around for those companies to show up. I want to use my edge, and I want to get those companies started and get them to market. And so I love venture studios. Like we're actually we work pretty closely with Entrepreneur First out of the UK, and have made quite a few investments in companies that have come out of that program.
Do you think YC is overhyped?
I think it has been at times.
Okay, hyped or overhyped?
I mean, it's just part of their job to create hype, right? Like they want these companies to go out and raise as much money as they possibly can, because they have an invested interest in all those companies now. So overhyped, I wouldn't blame Y Combinator for that. I just think they had a lot of interesting companies come out of those programs, and a lot of people have taken notice, and very naturally, a lot of people have wanted to go invest in those companies. So I wouldn't blame Y Combinator. I think they just became very, very popular source of really good deal flow for a lot of people.
Yeah, that's a good save. Okay. The next one I want to ask you is particularly about best and the worst pitch decks that you have seen. And the reason why I ask you this question is there's this notion in the market that if you are building a deep tech product, so your prototype matters the most, your team matters the most, as you've already said that, the execution and all of that stuff that matters the most. And most of the time, these founders, they create the crappiest pitch decks of all time. And you've seen that as well. So the question I want to ask you is like, what's the best and the worst pitch deck you've seen in the year? So if you can, give us some examples. And then going back to the earlier question, what's the attention span that you have when you look at any pitch deck? Is it like 2 minutes? You're probably going to spend like 2-4 minutes. So you look at the team. What else do you look for? And how can people make a better pitch deck for you guys?
Yeah. So I'd say I'll say a great framework to begin with is Sequoia has a pitch deck framework that they put out there that I think is a really good one, actually. So I'll point a lot of people to that. But you're right. We don't have a lot of time to spend on 2,000 decks every year. We have to be able to make quick judgment calls. And so what are we looking for? Probably a lot of the same things a lot of VCs are looking for. We're looking at the team. We're looking at development, IP, traction, competitive landscape, funding risk, what's their go-to-market strategy, all those things, all the above. We're generally looking for some amount of clarity in each of those areas, because absent those, we don't have like the full complexion of what that business could look like to warrant, maybe another call. But in terms of time, sometimes you'll get 1 or 2 slides in the deck and you'll know very quickly this is, not the team or the company. But generally I try and spend at least 5 minutes on the decks that I look at to really try and absorb it. But the worst decks I think are excessively long ones that don't get to the point. I think that's the biggest mistake I see a lot of founders make, where they think they need this elaborate explanation because it's so complex. It might be, but it needs to be boiled down into simpler terms for most VCs to even really be able to grasp what the company's doing, and limited by time. Um, the the best ones, like I said, I think they generally follow that Sequoia framework. I will say one thing I've noticed more recently that I think is sort of interesting is like there's like this new class of like sort of like marketing VC now, where like startups will take a small check from these like very small VCs, but then these VCs spend a lot of time writing like really lengthy blog posts and sometimes even like doing like short documentary videos on these companies, which is like kind of a new trend I've noticed more recently that I thought was sort of interesting. But I mean, at the end of the day, you've got to convey a lot of the same information. That just might be a more exciting medium for people to see.
Okay. Is that a good thing or a bad thing?
It can be a good thing because it'll get awareness of a company very quickly, and a lot of times, things like short documentary videos are pretty shareable on social media. I think people are kind of used to that nowadays with platforms like TikTok and whatnot. So I think it's a very creative approach. Where I think it can go wrong is, I mean, they can be too over the top sometimes, in my view, where they're talking about some small piece of software, but in context of like going to Mars, and I'm like, that doesn't really have anything to do with one another. I get the scale of ambition here, but let's be realistic about it, because at the end of the day, like as VCs and founders, you have to be very realistic about how your company is working. You can't be, wishing and hoping for success. And you just need to sort of face the realities, and getting carried away with over the top, language and videos and marketing doesn't necessarily accomplish that.
Is raising money a success metric? Is that a validation? What exactly is it?
Raising money. So, well, I mean, for a lot of companies, it is a success metric because, it's kind of in the vein of like the Peter Thiel's like 0 to 1, where like if you can capture or corner a large portion of the capital that would be invested into that segment, then you're guaranteeing some success, at least on the fundraising side for that business, because if everybody's invested in you, they can't invest in their competition. And so people have to sort of naturally go invest in you. And, we see that strategy played out in companies like SpaceX and Anduril, where, Anduril's sort of the big dog in the defense industry now. And it's hard to throw a rock and not hit somebody that's invested in that company, because they've done such a good job at fundraising. And it also is to say that there's not a huge number of defense investors, so they're having to look more at generalists or people that don't come from that world, and putting it in terms they can understand and get excited about will corner even more of that capital and guarantee even more of their fundraising success. And so I think that there is a competitive advantage to fundraising. SpaceX probably wouldn't be SpaceX if Elon couldn't raise the kind of money Elon can the way he does.
In total, how much they have raised in total? Because I remember you worked at, I think you guys you worked at Space VC, and then those were like one of the earliest investors in SpaceX, right?
I don't think they were an early investor in SpaceX. I didn't work there. I just advised the fund because I think it's a great investor that I really enjoy, Jonathan Cost over there. But how much has been invested? I don't know. I don't remember off the top of my head. It's not too important, honestly, because it's not like I'm going to go invest in like a new launch company right now. It would be silly to like go and try and compete with like one of the most dominant private companies in the history of private companies.
Totally agree to that. Totally. Okay. So the next one is, what are the cap table red flags for you?
Cap table red flags, yeah. Well, so I like to look at the history of the cap table a lot of times to see who's come in and out. In that audit, a lot of times you might find that there was a founder that left that they didn't tell you about. So that's always a red flag. If one of the things I started to notice, at least in the space and defense industry, were startups giving up a lot of equity to advisors that really didn't do much for them. Yeah, exactly. They might have come from the industry, but then they might not have worked with the startup and really know how to help a startup. And so, yeah, that's always another red flag, where there's a bunch of advisors that I've never seen or have helped the business. But I mean, the biggest one to look out for, though, in my mind, is you want to make sure that the founding team is incentivized long-term to stay with the company and build. And if they've been too diluted early on, with subsequent rounds of funding, their share ownership might be so small that they might not care if they stay or go anymore. And so they might be disincentivized from staying with the company, and that can be a big problem later on. So I always want to make sure that the founding team, the critical team members for that business are incentivized long term and have enough share ownership.
All right, cool.
Yeah, one of the other things I also notice I look out for are so a lot of deep tech is coming out of research institutions, right? Whether it's a university or a laboratory somewhere, they're spitting out from another organization. And I've seen very, very often too many of these startups being required to give up a huge percentage of equity to those organizations, so much so that it kind of runs into some of the issues we just talked about. So when I see a university trying to take 20, 30% of a startup before it's even raised $1, that's a definite red flag. And I unfortunately see that happening every day of the week in Europe, where I don't think most research universities or companies understand how to spin out technology. And they think, oh, I'm going to make a ton of money because I own 30% of a business that unfortunately nobody's going to invest in.
Totally agree to that. This is the most funniest one that that we've picked up on the list. Do you guys give clear feedback to the founders?
Oh yeah, I mean, we try to be kind about it.
Let's put it this way: the one that you reject. So the ones that you reject, do you guys give a clear feedback to them?
We very much try to do our best to give them very clear and honest feedback, because a lot of times VCs kind of don't have the courage to actually be honest about why they might not like a company because they're worried about hurting somebody's feelings. But I don't think that's ultimately very helpful. And I think there's a way to do it without hurting somebody's feelings. And
you don't say you're too early.
I mean, almost never, because we love to be first check. That's almost like if I would kick myself if I ever said that to somebody. Yeah, because that's just almost never the case for us.
Right. Awesome. It's always good to hear that, because one thing that I would learn is it's hard to share the one difficult feedback to any of the founder, because nobody wants to bear the burden and all that, but it's very, very helpful. If the right feedback goes to founder, a lot of the time it's very helpful to them in their. Okay. So Jeff, really appreciate all the wisdom, all the things that you talked about. So we do have this one small ritual on the podcast. And what we do is we ask all our guests a question for our next guest without telling who the next guest is going to be. All right. So I'm going to take the question from you, but we also got a question from you. And you'll be very, very happy to hear that question, because he was a deep tech VC as well. So do you think, the question that he left for you is, do you think we're going to have a full tolerant quantum computer within the next 10 years?
A fault tolerant quantum computer in the next 10 years?
Yeah, full tolerant quantum computer in the next 10 years.
Ooh, that's a difficult question. Yes, because one of our startups is working on exactly that. So, yes.
Okay. Thank you so much, sir. Thank you so much for all the wisdom and sharing the insights into the deep tech world, because I've always find this one sector very, very interesting, because there's not a lot of content out there on this particular sector. And one other thing that I have in mind is invite people from VCs from different sectors and founders from different sectors, so we can actually get to learn more about. You don't have to build the next SaaS company. You can build the next deep tech, next NVIDIA. You can build the next SpaceX or something like that. So I appreciate the wisdom. Thank you so much for the time again. This is it from today's episode. I hope you enjoyed it. Thank you so much for watching and listening. All the resources and links that we have talked about, they're all in the description or in the show notes, depending upon which platform you're on. If you're listening on Apple Podcasts, please give us a review. Would appreciate it. If you're watching it on YouTube, please mention down in the comment, did you like it? Did you not like it? What do you want us to improve? Who do you want us to invite on the channel? If you enjoyed this episode, there are chances you're going to enjoy that episode as well. So we're going to link it down somewhere here. Do hit the subscribe button if you haven't done that already. And thank you so much for watching again. And I'll talk to you soon. See you in the next one. Peace.